Welcome back to the Retire in BC podcast. In today's episode, we want to talk about building a resilient portfolio and all of the things that go into such a thing. And so, where I like to start with this a lot of the time is that I tell clients there are so many things going on within a portfolio. There are a million things to think about at the time. I usually tell our clients, you know what, it's my job to take care of 99% of those. Really, we need to make sure that we're on the same page as the client in terms of their goals, their time horizon, their general risk tolerance. But the client themselves doesn't need to be a total expert on everything to do with portfolio construction. That's my job and the portfolio manager's job to take care of. But I also tell them that, you know what, I'm always totally happy to give them a peek behind the curtain if they'd like to know more about what goes on within a portfolio. And so that's what today is all about, giving our viewers a little peek behind the curtain on portfolio construction.
You know, Ben, one of my pet peeves in the industry are these questionnaires. We use them too, right? But these questionnaires, these risk tolerance questionnaires, I'm sure our listeners regularly, or hopefully not regularly, but anytime you go to a bank or any financial planner, you get asked these questions, and they're there for a good reason. But what my pet peeve is that all too often they are a one and done. That whatever you answer, that's a bunch of check boxes, and it determines where you go. And I know you and I tend to use them much more like a conversation tool. They're an important tool, but they're just one piece of it to help us get into the mind of you, our listener, or our clients, to really understand uh, where your portfolio should be positioned.
Well,
And
a conversation and an education tool is
yes,
how I
yeah,
think of it, right?
that's
It's
yeah, yeah,
these are
that's
some
right.
questions that are going to jog your brain a little bit. This is how we think about things in the industry. And so those questionnaires, yeah, are good back and forth for education as well.
So like probably the most important thing to understand is the single biggest determinant of anybody's return is actually a very simple: how much do you have invested in stocks versus bonds, or small cap versus large cap equities. It's the asset allocation. That simple, at the end of the day, simple determination is the single biggest driver, more than the individual stocks that you own, more than whether you're dealing with me or Ben or somebody else. It's that decision, and so it's probably the most important decision, or at the very least one of the very most important decisions that you can make.
Well, and hence why I said it's very important for the investor to be aligned with the advisor in terms of what
Yeah.
their risk tolerance is. We can come to an agreement on what that general asset allocation is going to be and what the general behavior of the portfolio is going to be. And then, like we said, it's our job to make sure then that the portfolio is globally diversified and it's diversified across different asset classes and things like that, sectors, industries, so on and so forth. So we'll touch on a few of those right now. Probably circle back to some of them a little bit later. But really, diversification within a portfolio, extraordinarily important. This is one of the few areas that you can actually reduce your risk and increase your return at the same time through proper diversification. So it is something that we want to highlight pretty in depth here.
Well, yeah, good point. Phrase I often use is it's one of the few free lunches that we get in the business, actually reducing risk and enhancing return by doing that. And yeah, I think there's the big five areas of diversity: geographic, asset class, sector or industry, individual securities, and style or factor. And I guess within that, yeah, value, growth, small cap, dividend. Those are sort of the main ones. Highlighting the importance of that diversity, let me just tell you a quick story going back to 1999. I'm at the time still a fairly newish advisor. Um, I had some experience under my belt, but we had a phenomenal run in the tech sector. The tech was just doing great. The NASDAQ um, index was shooting the lights out, doing two, three, four times what any other area was. And typically I would have about 10 to 20% of my clients' money in a portfolio in tech. In fact, at the time, I think my allocation was about 20%, a little bit higher than it even should have been, but a significant weighting. And back then I had a client come to me one day and we went through their portfolio and they said they pointed to the category of tech and said, how come I don't have more of that? And I said, because we want diversity. And they said, no, I want more of that. And I said, no, you don't. You want it to be more diverse. Well, at the end of the day, being a newer advisor, I let myself get badgered into, or basically forced. I mean, the client basically said, I either do this or I'm going elsewhere. So we put the majority of his money in tech. Well, sure enough, the next year in 2000, any of you that are older and listening to this will remember the tech bubble in 2000. The tech market fell in the neighborhood of 90+%. It was an insane drop, bigger than anything we had seen since 1929. But had I stuck to my guns in that particular case, the client would not have lost near as much money. But because I let him badger me into it, it was a catastrophic loss for that individual. Um, so again, it just highlights the absolute importance of not letting yourself um, be focused on one specific sector. You might do well, but you might not.
Oh, well, that's exactly it, right? It's that different industries are going to sometimes do well, sometimes do poorly. They're going to zig and they're going to zag. And by diversifying across all of them, you're participating with the winners. You're also participating in the losers, but it definitely does a lot to
That's right.
tame that volatility. And really, that's the same story across all of these. We're just trying to highlight the word diversification comes in a lot of different flavors. Not only is it geographic diversification, you don't want all of your money in Canada or all of your money in the States. Same thing with the asset classes sometimes that we've talked about, different sectors and utilities. And so to Arnold's point, if let's say we both have a globally diversified portfolio, but mine is 100% tech and his is 100% utilities, those are going to have very different
Totally
return
different. That's right.
profiles and yeah,
That's
exactly.
right. Yeah. Yeah.
And so yeah, go ahead.
Well, and I think the other thing maybe to point out is um, diversity doesn't necessarily always mean having a whole bunch of one thing. Or sometimes you can have one thing that is diversified inside it. You can have one mutual fund that is diversified inside it. It has all those categories and a whole bunch of different companies. And in fact, actually, even one of my favorite stocks, I would classify as a very diversified stock. Warren Buffett's Berkshire Hathaway. It's 40% private equity and 40% publicly traded companies, or maybe now 30%. But it's diverse. It's one stock, but it's diverse inside it. That's a case where I wouldn't want that to be the only thing I own. Um, but again, sometimes you can be very diverse, but it can be very simple on the front end.
Yeah.
And I guess we'll
Well,
talk about that a bit later
yeah.
too.
Well, and I mean, a stock like that, it's got less of the stock specific risk than a lot of
Exactly.
other stocks. It still does have some though, and so we would call that idiosyncratic risk, as in it only belongs to if you only hold that, you are exposed to those risks. If you hold a bunch of things, you are
That's
less
right.
so. And so partly, if that single stock is a small portion of your portfolio, that in itself is diversification. But when it comes to a single stock, it's basically the idea is that within that single stock, you've got the risk that maybe the CEO quits or maybe they have issues with a single supplier. And so that particular stock could get hit when the rest of the market doesn't. If that single stock makes up 50% of your portfolio or more, that can be really devastating. Whereas if you hold 100 stocks, this idiosyncratic risk it's no longer a risk. It's just something that will happen to a certain portion of those stocks every year or every few years. Um,
And the
so
other ones are going
that's
to make up for it. Yeah.
exactly, yeah,
Yeah. That's
yeah,
right.
yeah. So actually, the other thing I'll add on to that is just usually our clients aren't asking for a heavy portion into single individual stocks. Just that sometimes when we see that happens is when people have stock options through work and they've never diversified away from that. So just a caution on that front, that it does expose you to more risk than if you were to diversify away from it.
Yeah, absolutely. Absolutely. So I guess there's a few other investment styles to consider when you're building a portfolio, um, active versus passive. And we can build portfolios that have either factor-based investing. Ben, I think you're a real fan of factor-based investing, right? And maybe that's a topic for another podcast. I don't know, but
Uh,
strategic investing, that's more of a pension style. Tactical approaches, uh, income approaches. Sometimes those can be valuable if you're in a situation where um, you need regular income and dividend income is taxed more efficiently. In special types of accounts, that might be a route you want to go. And then you can get even more creative with liquid alternatives and hedge funds. All of those styles or all of those philosophies can be built into a portfolio depending on what's needed.
yeah, and I wonder if we could just go by one and just really briefly sort of describe what some of those are that you just mentioned. So maybe I'll go through that a little bit. But in terms of the active versus passive debate, I'm sure some of our viewers are pretty knowledgeable about the pros and cons. Others might not be. The gist of it there is just that active management is more when you're paying for somebody to try to beat the market. And there's a pretty hefty debate about whether or not they can do that on an after fee basis. But then the alternative to that is a passive investment where basically you're just buying the market, buying what everyone else is buying. Um, I have some criticisms there in that you're still making a lot of active decisions to decide what your passive allocation is going to be. But it is something we, yeah, may or may not get into in a future episode. Factor based, like you said, I'm actually a big fan of factor based investing. That does tilt actually closer towards the passive side of things. But basically, the idea is that when you look at a data set, um, and this is pretty robust across different markets and different time periods and things like that, you can filter out that there are certain rewarded risk factors. So, in the same way that we would say, you know what, stocks generally speaking have a higher return profile than bonds, that's not for free. There's a risk attached to that, and that's why that relationship exists. But basically, you can look at a data set and you can filter out and find things like, oh, you know what? Generally speaking, small cap stocks tend to outperform large cap stocks. Again, that doesn't come for free. Small cap stocks have more of that idiosyncratic risk that we talked about before, but it's basically diversifying across different risk factors. Again, that too we may get into at a future date. Then, like you said, there's kind of the strategic versus tactical approach. Strategic being a little bit more, we've decided that this is what the portfolio is going to look like, and whenever it deviates away from that, we're going to rebalance to it, versus a tactical approach, which is a little bit more, again, on the active side, the portfolio manager is making calls in terms of, you know what, we like this sector right now, or we like this currency, or what have you. And then yeah, as you talked about, any number of other strategies under the sun. We can just say the word hedge funds, and that encompasses 50, 60, a million different strategies that they can employ. The word hedge fund um, really doesn't mean too much, just means that they have their own strategy in terms of trying to make a return.
Yeah, hedge funds can be just about anything, long, short, pork bellies, whatever. Well, actually, I don't think pork bellies are actually on the exchanges anymore, but they used to be. But yeah, hedge funds can be anything. But there are times that those kinds of strategies can be a diversifier for a
For sure,
portfolio,
yeah.
and they may or may not be appropriate.
Well, and for an example of that too, just to pick one out of a hat, yeah, well, because I went through this in the CFA, there was a pretty hefty chapter on hedge funds, but just to pick one out of a hat, that you've got merger arbitrage. So this is a hedge fund and a portfolio manager who specializes in finding companies that they think one company is going to merge and acquire with, or sorry, merge with and acquire another company, and so they'll do some math in terms of what each one is valued at, and they'll buy one and they'll short the other. And that's their entire portfolio strategy, is just find companies that are merging, buy one, short the other, and try to make a return that way. So that's just one of the many, many examples of a strategy that can be employed within an investment portfolio outside of just us saying, oh, and invest in a lot of things and diversify. These are different strategies that can be employed.
Well, and that would be a strategy that probably you wouldn't want to be your sole strategy. You would want it to be something that is an addition to a bigger strategy to just give you some of that diversity, right? So
Right,
I
right.
I think at the end of the day, for our listeners to understand, what's important for our listeners to understand is that your portfolios, most portfolios, I think, can and do look fairly simple on paper, but they are the product of a lot of decisions and a lot of thinking behind the scenes. Um, that in addition to that, we're looking at tax efficiencies, at currency exposures, um, when to rebalance them to the right time, how to best allocate that risk, not just for stocks and bonds, but for everything in between. So, if you think of it like your dashboard on a car, um, what you see there hopefully is fairly clean and simple. You can see very quickly at a glance how things are going, but there's a whole engine underneath there doing a lot of stuff that maybe you know lots about it, maybe you don't, but what you want is that very simple interface. And that's what we want to give you is something fairly simple and high level to just help you understand what's going on.
Yeah, yeah, for sure. So I think now we'll maybe circle back just a little bit to the global diversification point. I just wanted to make one quick comment here, and that I'd mentioned before, you don't want all of your money in Canada, or you don't want all of your money in the US. Generally speaking, that's true. You want to globally diversify your money. There is such a thing as home bias, and I'm going to position that some amount of home bias is okay. Too much is probably a bad thing, right? And so, just while we're on the topic, I mean, at the end of the day, you're going to be, well, if you live in Canada, most of our listeners probably are, you're going to be spending in Canadian dollars. It makes sense to have a little bit of overexposure to that currency and to those companies and to our economy at the end of the day. Additionally, there's some tax reasons within the portfolio. You might, that they might get some tax breaks for investing within Canadian companies and things like that. But just I like to caution, sometimes when we see outside portfolios, or someone brings me their stock portfolio that they've had for a long time and it's 100% Canadian, and I think, ooh, that's probably not the best thing you want to do. In my opinion, anywhere from like 10 to 30% in Canada is a pretty appropriate range. We only make up 3% of the global stock market. And so even that is a pretty significant deviation from the global market cap.
Yeah, no, I'd agree with that. I would add that that portfolio doesn't necessarily, or that strategy doesn't necessarily need to be consistent across every single account that you have. So, for example, to my point earlier, or to Ben's point earlier as well, there can be advantages to investing in Canada, particularly in a non-registered account. that advantage doesn't exist in a TFSA or an RRSP. So in those TFSAs and RRSPs, that's where you want the lack of a home bias. But in an unregistered account, you might definitely want a home bias. For many people, dividend income is tax-free, or sometimes it's even negatively taxed. So you may want a higher proportion. You may want that to be 100% Canadian, as long as it doesn't represent the majority of your portfolio.
Yeah.
Right. So it's when you're looking at it, we're not looking at any single one account and saying this, we're saying it on a larger scale, the portfolio as a whole. You do want to develop that diversity.
Yeah, and when we're talking about that diversity too, well, especially with globalization and everything like that, really we kind of break it down into four pretty big categories. We've already talked about Canada and the US. Other than that, usually within the industry, we just break it up into two more categories, at least on the equity front, being just everywhere else gets broken up into other developed economies and other emerging markets. And so typically speaking, you do want some exposure to both of those categories as well as Canada and the US.
Yeah, and in fact, actually, I think it's worthwhile noting sometimes when you're looking at summaries of accounts, often the terminology that they use is Canada or US, or sometimes North America will be lumped in. Uh, and then the other will be foreign, um, or sometimes international, but meaning those developed international, and then they'll have emerging markets separate. That's quite a everybody does it differently, but that's quite a common breakdown, that slightly different words than just used, but common in terms of how they break them down. If you're looking at your own portfolio and wondering what's in it.
Yeah, yeah, exactly. So then, other than that, I mean, we've already touched on this as well, but it comes down to the asset class diversification. So not only are we talking about stocks versus bonds, um, sort of just to diversify one from the other. Um, and I should highlight before too, I'd mentioned that sometimes diversification is a free lunch and that it can raise your return as well as lower your risk. Really, when we're saying that, we're talking about if you have two asset classes that are you think are going to have a similar return profile,
Right. Yeah,
but
good point.
they're not correlated. So I'm trying to suggest that it's not as though by adding bonds to your equity portfolio we're going to manage to raise your return. That's probably not the case. But if we have this kind of stock and this other kind of stock, and we think both are going to have a similar return profile,
Right.
just not at the same time, one's going to zig and the other's going to zag. That's where you get the additional benefit
Or
from.
even geographies.
Yeah,
Yeah, that's right. Yeah, yeah. But yeah, absolutely. I mean, if you're heavy to bonds, you're going to earn less money. If you're heavy to stocks, you're going to earn more money, generally speaking. Yeah, in that sense, there is no free lunch, but with the certain other diversities, there are.
yeah, exactly. Well, and then you've got other things too, like real estate or real assets that are kind of in the middle there,
Right, right,
alternatives,
right.
right? Whether that's commodities or what have you. Um, so yeah, good to have some element, some mix to reduce the risk there
Well,
in the
I think,
portfolio.
yeah, we talked about that already. It's not just about getting higher returns. It really is also about reducing risk. And probably the biggest risk reducer is the one that lowers your return. It's adding in the bonds.
Well, or cash,
Or
right?
cash. Yeah,
Or
absolutely. Yeah,
yeah,
yeah. But there is also an amount of risk reduction in the other diversities as well. So that's where hopefully you sort of get both.
yeah, actually, and I think sometime, probably not on the podcast, but I might do a little video sometime, just proving mathematically why that's true. Why you can take
Right, right,
two stocks that are equally risky, quote unquote, and by adding the second, you reduce risk in the
right,
portfolio.
right, right.
And so yeah, that's sort of always an interesting thing. I think I want to come to something now, and this is kind of what prompted the episode a little bit, was that in the news we've had a fair number of clients asking, or some variation of, I turn on the TV, I see the Nasdaq is down and the S&P 500 is down, and it's down, let's say 5% on the week, how much has my portfolio fallen? Or how much do I need to worry? Or like how much of that is true? And so maybe I'll turn that over to you, Arnold. Because it was, sort of your comment to begin with.
Well, yeah, no, it's true. It is a question that I get asked probably at least once a month, maybe every other month, but often enough. How do I correlate what I see in the news to what my portfolio is doing? And the absolute truth of the matter is your portfolio may not look anything at all like what is showing in the news, but often there are elements of it that are absolutely correlated. And so a simple thing that you can do is be aware, first of all, of how much you have in stocks and bonds. And the simple thing to do is to say, I'm just going to assume my bonds don't do anything up or down. And so if I have a 50% weighting to stocks and I see that stocks went down by 2%, well, maybe my portfolio went down by one. That would be the simplest thing. But even that would be probably a little bit too simple, because probably you've got a mix of international, US, and Canadian. And so personally, I know what I do. I tend to just assume that I've got a 50-50 mix. That's not what it is, but when I look at what did the Dow do or the S&P 500. Usually they're fairly correlated. And I average that out with what the Canadian dollar did. Sorry, with what the Canadian index did, the TSX. But then I also back off a little bit depending on what the dollar did, because if the US investments go up by 1%, but the US dollar goes down by 1%, well, it's like it did nothing, right? And the US dollar going down by 1% is the same as the Canadian dollar going up by 1%. So for me, the quick formula is TSX averaged with Dow minus the currency exchange, right?
Nice and
And
easy.
yeah, but for most people that's too complicated. So
Yeah.
probably the easier is to just average the two, right? Um, your portfolio, it depends on how it's positioned. It may or may not be that correlated, but the odds are that's going to be a kind of close approximation. But frankly, the best thing to do is to be Rumpelstiltskin, go to sleep, don't ever look at it, and maybe once a year talk to your advisor about it, talk to us about it. That's the best thing to do.
No, I agree. And just to touch on it quickly or clarify, all of those, math things that you're doing in terms of how your portfolio is doing versus what the news is doing, that's all for the equity components in your portfolio. If you have a heavier allocation to bonds or cash or whatever, if you have a more conservative portfolio, then it won't have moved as far up or down
That's
in
right.
all
Yeah.
likelihood.
Yeah.
And yeah,
Yeah, you have to multiply that whole thing by your proportion to the stocks. Exactly.
and then
That's
figure
right.
out what your bonds have done. I don't recommend doing that
No, no. Assume they did
based on
nothing.
the treasury curve and interest
Yeah.
rates and
Yeah.
yeah,
Assume they did nothing.
exactly. Yeah, but I'd agree too. Um, turning on the news and stressing out about your portfolio is probably not helpful. Now, I know it's human nature to do that sometimes, and so we're always happy to chat with any of our clients about what's going on in the markets. But I agree, usually it's best to turn it off, take a look at your next quarterly statement or your next annual statement, and try to ignore some of the noise in between.
I knew a guy that used to call that financial pornography.
Mm.
Stop watching financial porn, because it is true. The media sensationalizes it, and they make you want to watch it and look, and so it can be a little bit hard to get away from that. But it's probably for the best.
Well, yeah. What is it? The saying that economists have predicted 9 out of the last 2 recessions,
Yeah,
or
yeah,
whatever. So
that's right.
yeah. So yeah. Other than that, just kind of want to leave our listeners with just reiterating that it's not on you to, well, at least if you're our client, it's not on you to build your portfolio and to worry about all of these things that we've talked about in this episode. Really, the big items are what are your goals? What's your time horizon? What's your general level of risk tolerance? And then beyond that, you know what, it is helpful to ask your advisor, am I globally diversified? Am I diversified by sector? And actually, well, I'll tell a quick story here as well. I met with a new client a couple of months ago, and they had a portfolio at the bank that was entirely the NASDAQ. It was, so they were very heavily exposed to US tech stocks. And this is much more recent than your 1999 example. Didn't go as poorly because we managed to transfer the assets over and get them diversified globally and across different sectors. So, you know, I'm saying it's not your responsibility or the investors to necessarily tweak all of these things, but it is worth asking your advisor, why is my portfolio constructed the way that it is? How does that make sense? And if you have any concerns, keep digging, keep asking those questions. I think it's always helpful to educate yourself and know a little bit more. You know, again, don't stress about it, but yeah, just sort of wanted to mention that.
I actually think a great way to put that is delegate your responsibility, but don't abdicate it. You know, you are ultimately responsible for your money. You know, but it's okay for you to delegate it to us, but I wouldn't abdicate it. Ask the question, because sometimes, and it's true, I've seen the same thing as Ben's seen there. Sometimes we see portfolios that are not constructed very well at all. Most advisors do a half decent job, but sometimes people want to do it themselves or whatever it is, or sometimes some advisors don't do a good job. So ask the questions, because it is incredibly important, especially as your assets grow, especially as you get older. You want to make sure that you have that properly built portfolio that's structured in a way that suits you for your time horizon, for your risk comfort level, basically the best solution all around for you. So, I mean, if there's something you've always wondered about your portfolio, but we're afraid to ask, now's your chance. Reach out to us. We may even use you as an example in future podcasts, whether you're working with us or not. If you're working with us and you want to know about your portfolio, ask. If you're not working with us and you're not sure what you've got, feel free, give us a shout. We'd love to help you out. Thanks for tuning in, and see you next time.
Thanks. Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.